Hey guys, this is Tajim Brown McBean, and today I will be answering some very important questions for you. So we are gonna compare a financial health measurement that will help you to answer the following questions, right? So question you're gonna get answered is, how will I know if I need more income? How will you know if you have too much debt? And how will you know how to improve your finances from being bad to average or to excellent? So these are the questions that you might have that we are going to give you answers to. And this financial health measurement, we are going to show you how this one works. All right. So today we're going to go in depth with what is a debt to income ratio, right? What is a debt to income ratio? So a debt to income ratio is a financial measurement that lenders use to assess a borrower's ability to repay. So when you go to the bank and you apply for a loan, this is the measurement the banks use to say, okay, will this individual be able to repay the loan, right? So they do that assessment before to decide if they are going to approve you for the loan or they are going to reject you for the loan. All right. So most people, all right, so I'm going to show you how to do this calculation. The first step, you're going to need a total of your monthly debt payment. All right, so you're going to add up all your monthly debt obligations, which will include your mortgage payment, your credit card payment, your student loans, if you have student loans, your auto loan payment, personal loan payments. So personal loan payments are similar to what we call in finance consumer loan. Like if you have a loan to purchase furniture and things like that, right? And any other monthly debt payment. So you're going to do a grand total of the monthly payments that you have to make for your loans and credit cards. That's step one. So step two is your gross income. So your gross income is your income before taxes and deductions, right? So the total, what you're earning, your total monthly income before taxes and deductions, right? So this includes your salary, your bonuses, your commission, if you have rental income, if you have any other source of income, you have a side hustle, as people call it nowadays. Yeah. So all of that in one grand total, right? And this is how we're gonna do the calculation. So some of you might be asking, what's the relevance of this? We're getting to that. We're getting to the relevance, right? So step three is the formula. So the formula is your total debt payment, your total monthly debt payment divided by your total monthly gross income times 100. All right. So if your total monthly debt payment is 150,000 and your gross monthly income is 500,000, this is what the calculation would look like. 150,000 for your total debt payment divided by your gross monthly income of 500,000 times 100, and then you get 30%. So you're wondering, what does this 30% represent? So this is where we explain how to really fix your money problem. All right? So it comes in ranges. So the debt to income ratio has 3 ranges. And these ranges are range 1 is excellent. So 0 to 35% is excellent. Range number 2 is average. 36% to 49% is average. And range 3 is bad. So if you fall in range 3, it's bad, right? Which is 50% and above or greater. All right. So story time. So Mary decides that she wants to take a loan, right? And she goes to the bank and she applies for a loan. And Mary had a good experience, as some people would say, right? Now Mary came back to work and told her co-worker how all she had to do was sign the paper here and sign the paper there. She didn't have a lot of hassle, right? So the other co-worker was encouraged now by Mary's experience to go and apply for a similar loan. So Mary is earning the same as her co-worker, right? I just putting that in. And the loan that Mary had applied for, the co-worker, we're going to call the co-worker Jane. Jane is going to apply for the same amount. But when Jane got to the bank and come back, Jane's story was totally different. Jane was saying, oh my God, the only thing left for the bank to ask me about is I had to tell them everything, full bill and receipt. What that means, guys, is that everybody's situation is going to be different. And that difference is based on these ranges, range 1, range 2, or range 3, right? So Mary's situation is one that she falls into the excellence category, right? So she don't have a lot of loans. And so when she's applying for a loan, and this additional loan is going to be added to what she currently has, when the bank does the calculation, she is at the excellent range, which is range 1, right? So when Jane goes to the bank, Jane might be in the bad category. You see, I never put her at average. All right. If you're at average, the bank would ask you for, yes, additional things than the person that is at excellent. But it wouldn't be anything stressful. When the banks are asking you now for what seems like a whole life story, it means they are cautious. They are trying everything them can think of to say, how do I get a good assessment of what is going on with this individual and their finances? So that's what the bank is doing, right? So that is why Jane had that experience, because our money must stay right. So Jane would have fallen into the bad category. So this is why when different persons go to get a loan, even if you have the same salary as the other person, and you're applying for the same loan, your situation might be different from another person's situation based on the other things you have in your portfolio. So your income and your debt, these two things affect the majority of all your financial health income and the loans and the credit card you have. These two things will really determine the health of your finances. All right. So what does range one mean? Excellent, right? When the bank does the calculation, what does it mean to this? So range one is 0 to 35% or anything less than 35% or less. This means that you are looking good in the eyes of the lender relative to your income. You see, word income come up back again. Relative to your income, meaning compared to your income, your debt is at a manageable level. So in finances, every number represents something, right? So there is nothing you can do in finances that you will have a number and it does not represent something, right? There are different guides as to what are the benchmark. Benchmark is something that it is used for you to know where you are. And this that we are showing you the different levels, range 1, range 2, range 3, it is showing you a guide of what is a best practice in the financial industry. All right. So range 1, Mary fall under excellent, easy peasy. She go apply for a loan, all is well. She get through, not a problem. Range 2 is average. And this is when you do your calculation and you are 36% to 49%. What this means to the financial institution is that you have an opportunity to improve. So this means you're managing your debt adequately, but you may want to consider to lower your debt to income ratio, because your debt to income ratio tells your banker or your lender how well you're managing money, right? So if anything should come up, from time to time, you will have expenses that you never planned for. And these expenses might require you to take additional debt. Now, if you take additional debt being at this average range, you might get pushed over into range 3, which is the bad range, where that is the range where all hell start break loose. Yep, that is the problem range, which is bad. Bad, 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 bad. So it is when you do the calculation, you divide your total monthly payments for your loans and your credit card. You divide that amount, you total it, and you divide it by your gross income. And you times it, your gross monthly income, and you times it by 100, and you get 50% or more. Then this is mucho bad, right? So what this means to anybody in the financial industry is that you have limited funds. You see, the bank can even tell you what is happening with your money. You have limited funds to save or spend. That is what this category means. So lenders will limit your borrowing options, or they might straight out reject you. Now, I went to a business, or what we call a corporate mingle, and I was talking to somebody. She was talking about her experience. She went to the bank. She wanted to get a loan to pay for medical expenses for her mother. All right. So she said her experience was not good. So she kept saying that she was rejected for the loan and she never understand why she got rejected for the loan because it's a medical expense. So what a lot of persons don't understand is that the bank does not give you a loan based on how important the loan is to you, because the bank's first concern is to calculate or to assess your ability to repay. That is their number one concern. So here lies the problem when people have the impression that the banks are there to just lend them money when they need it. That is not so. That is a myth. That is a misconception. That is a misunderstanding. No go so, as Jamaican people would say. What it means is that when the banks do this assessment, comparing your income with the loans and the credit cards you have, if you fall into the bad category, expect very high interest rates or expect being rejected for the loan. All right, so how does this help you, right? So we are not only pointing out a problem, we're also going to give you the solution. Okay, so let's do 3 calculations together. All right, so take out your calculators and let's do this thing. All right, so your total monthly debt, that will take you some time to do some calculation. Well, as a matter of fact, we're going to give you some examples and use that afterwards because you have had the practice. You'll be able to do your own calculation to see where you fall, right? All right, so your total, so here is the examples that we're going to work with. All right, so a person who has a total monthly debt of $46,564, we're going to divide that by their gross monthly income, which is your income before taxes and deductions, is $127,879, right? And then we're going to times 100 to get the percentage. When you get the percentage now, we will now look at where this person falls. Do they fall in the excellent category? Do they fall in the average category? Or do they fall in the bad category? All right. So I'm going to give you some time to do that. All right, so some of you might have gotten your answers. So just make a note of that. So this would be number 1, right? So write number 1 and then you write a percentage beside it. All right, so number 2, imagine your total monthly debt is $62,023. And you're going to divide that by your gross monthly income, which is $142,222. And remember to times 100, right? We're going to times 100, right? And then the percentage that you have, you're going to write number 2 and write the percentage. Okay? All right, so I'm giving you a little time. Da, 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 da. Jeopardy. Whatever. All right, so number 3, total monthly income of $134,787. You're going to divide that by the gross monthly income, of $250,121. And then you're going to times 100. So this will be number 3, and you're going to write the percentage for number 3. All right, so I'll give you a little more time for those of you who never had any calculator or anything to work with. You can just run, go get it, and come back. So the next thing we're going to talk about is what it means. You understand? And how it affects your financial health. All right, so we're moving right along. Okay. So right here, before I move along, if you want, you can just stop the video, do the calculation, and then when you're ready, you move to the next. You continue playing the video, and then we'll get to the next part where we explain what is gonna come next. All right. All right, so the answers for number 1, tell me in the comments if you got it. 36.41%. All right, and as I said before, the excellent category is from 0 to 35. So this person falls into average. They fall in the average category, and the average category is what we call you need a little improvement. So you're doing okay, right? Nothing to write home about, but things could be a little better. All right, so number 2, the answer is 43.6%, right? And this is still average because the average range is between 36 and 49%. Okay. All right. And number 3 is 53.88%, which is bad, which is, we call it take action. No, as some people in Jamaica say, no lay. And the translation for that is get up and do something, take action. This is important, this is urgent, move. So if you are at bad, we are going to show you how to change that bad rating to either average, or what to do to improve your rating so it moves from bad to average or excellent. Keep up. So just waiting for a little bit. All right, I think you guys get an understanding of this, so we are moving right along. So as you can see, your debt and your income, both things affect each other. They are compared with each other to see, yes, you are doing well with your money or you are not doing well with your money. All right. So some of you might have a little challenge with thinking about how you're going to do this calculation, because you are what we call an irregular income earner. So how do you use this debt to income ratio if you are a person who earns an irregular income? So this means people who do not get the same amount of income each month or each week or each fortnight, right? How you do the calculation? So examples of these people like the sales agents, business owners, insurance agents, real estate agents, and so on. You get the point, right? All right. So here's what people like you are going to do, right? So how should irregular income earners calculate their gross income? So what you're gonna do, people, you're gonna add 12 months of your income and divide it by 12, right? So you're gonna get, this is gonna give you an average monthly gross income. And you're gonna use this now to calculate your debt to income ratio. All right? All right, cool. So everybody on the same page now. All right. So here is how you're going to improve your debt to income ratio, right? This is how you're going to improve your financial health. Number one, if you fall into the bad category, people, here are the things that you will need to do to move it from the bad category and go over to the average or to the excellent category. Number one, you're going to increase your income. So ask for a promotion, you understand? Anything that you think will increase your income, that is where your focus will be. Other things you can do as well is to pay down existing debt. Is there a debt that you have currently that it soon pay out and you have a little money that you can pay to the debt, pay off that loan or pay off that credit card? Then it would be a good idea to do so, because what is going to happen is that when you do the calculation again, your percentage is going to change, and it's going to change and go, basically it's going to change from the bad category depending on how much difference was made in income and how much loans you actually paid off, how much credit cards you actually paid off. And using the debt to income ratio, it will show you how much progress you are making. Number three, you can consider consolidating a debt, consolidating the debt if it results in lower monthly payment. All right. So some people might say, why would I consolidate the debt? Remember, the calculation is based on income compared to monthly debt payments. So if you reduce your monthly debt payment, automatically, your debt to income ratio is going to improve. How much improvement it will be based on how significantly lower your monthly payments to those debts have become. You understand? Okay. Number four is to refinance high interest debt, right? So if you have any loans and credit cards that the interest rate is high, you have the option to go to your bank and ask about refinancing. How does the process work? And if I were to refinance these loans, what would the end product look like, right? So when the banks or the lender do the calculation for you and tell you all the things that would be required, you can plug the information, people, into the formula for the debt to income ratio, and you will see if it makes sense, yes or no. So by having these types of tools, You don't have to depend 100% on the bank to figure out if you're moving in a positive direction or a negative direction. By doing the debt to income ratio, it will tell you if your situation bad, if it's average, or it is excellent. Okay? All right. And number 5, I find that persons who generally end up in the bad category, which is the 50% or more of their income going towards debt, are persons who, as soon as they pay off a debt, they get another one. It is not monopoly money. It is your hard-earned money, and it affects the health of your finances. Financial health is a big deal. The person's talking about generational wealth. You see, I keep bringing that up in all my videos. Generational wealth, your money has to be structured in a way for that to be possible. And each loan that you acquire, that you take, that you add, this debt to income ratio, you can actually put that additional money in the calculation to see if you can manage more debt. So avoid taking new debt, especially if you're in the bad category. If you're spending more than 50% or more on loans and credit card compared to your income, don't take no more debt. And a debt consolidation loan is not more debt. It is what we call a swap. It is an exchange. So a debt consolidation loan, what it does, it takes, say you have 5 loans, it consolidates it. It can be consolidated into one. That is the normal way of doing it. But also it can consolidate at least 2 or more loans into one. And by doing that, you have one due date, you have 1 monthly payment, so it is easier and simpler for you to make your repayment. Okay? All right. So in today's video, we said that we would help you to answer the following questions. How will you know if you need more income? So we answered that, right? And the answer was you need more income if you fall in when you do the debt to income calculation, which is your total monthly debt divided by your total gross monthly income times 100%. If you fall into the bad category, you need more income. If you fall into the excellent or average category, then you are okay. It's not bad, right? But if you are a person that you definitely want to be in the average category, if you're in the average category and you want to be in the excellent category, that is mucho fine, then you would need more income to move up to the excellent category. Or sometimes all you have to do is pay off a loan, do the calculation. As a matter of fact, you can do the calculation first to see if you pay off a loan, if it will move you from the average category to the excellent category. Okay? So you definitely need more income if you're at bad. Definitely, that's a full-blown yes. Once you fall into the bad category, yes, resounding yes, you need more income. If you fall into the average category, probably the only thing you might need to do is just to pay out a one loan here or there, and then do a recalculation of your debt to income ratio, and you might find yourself into the average category or probably into the excellent category, because we don't know what the amount of the loan that you're actually paying off. But when you do the calculation, it will tell you exactly what is happening so that you know what to do. But bad, you need more income. Simple. So we have also explained to you how you will know if you have too much debt. You have too much debt if you fall into the bad category. If you are at the number 3 range, which is your total monthly debt divided by your total monthly gross income times 100 is 50% or more. Once you fall into the bad category, you have too much debt. Full stop. Okay. And the final question is, we have shown you how to improve your finances to move from the bad category, what you can do to improve your situation. So the action that you take will move you depending on the effort that you make by you increasing your income, reducing the loans that you currently have. You can consider a debt consolidation if it improves your monthly payment, meaning the monthly payment that you're going to pay is going to be less than what you're paying now. If it does that, you can consider it. There's also refinancing of high interest loans or high interest debt. If that improves or that lowers how much you pay per month for the loan, that is also a plus. And last but not least, avoid taking more debt, because the more debt you have compared to the income is the worse your situation will be. So this was a lot to digest, people. So take your time, make your notes, and I want you to do your own calculation and see where you fall, right? So if you do your calculation and you're 50, no, let me do it up. Yeah. If you do your calculation and you're 50% or over, what is that? You're good or bad? Bad. Yes, people. And we don't want your financial health to be bad. We want it to be at excellent, but if you're not at excellent, then you can work with average, right? Until you take your time and get to the excellent category. All right, so conclusion. So monitoring your debt to income ratio is crucial for maintaining financial health and improving your chances of securing loans and mortgages. So all of this impacts a lot. So a person might be saying, oh, I don't think I'm going to get another loan, so this is not important. People, you might be thinking about buying a house. And if your numbers are in the bad category, you won't qualify for a house. If you're 50% or more using debt, when you compare your debt to your income and you're using 50% of your income is going towards making debt payments, loans, and credit cards, you're gonna have a struggle with getting a mortgage. So this one measurement helps you do what? It helps you to see where you are financially compared. Income-wise, do you have enough income? It also tells you, do you have too much debt? It also tells you if you were to apply for additional loan, what the likely outcome would be. If you were to apply for the mortgage, what the likely outcome would be. Because you can go to your loans officer, call the loans officer and ask them about, say you are interested in getting a car loan. And they tell you, okay, a car loan, you need, say, you give them a price of a car that you're interested in, and they do the calculation and they say, you're going to need an additional, say, 30,000 per month. And you crunch the figures. You put that additional 30,000 per month to the total debt payment, monthly payment that you have, and you divide it by your gross income, monthly income, and times 100. And you will know crystal clear. It will be easy peasy for you to know where you stand. And this is why we do money coaching services. This is how we advise our clients, because clarity is the number one thing for us to provide to our clients, so that you know what you're doing, why you're doing it, and what outcome to expect. So what, when, where, and why. Why are you doing it? Can you afford so much? How much more income will you need? Because when you increase, say for example, you say, all right, I'm going to see if I'm going to start a side hustle. And the side hustle might give me another 50,000 per month. I'm just calling some figures, right? When you put it in the calculator now and you crunch the numbers and add it to your gross monthly income, you're going to see how much 50,000, additional 50,000 is going to improve what percentage you get. Is it going to take you from the bad range to the average range or the excellent range? All right, guys, so this is Tajina from Money Coaching Services. Yes, you can visit our website at moneycoachingservices.com, and please remember to subscribe, hit the notification bell, and please leave a comment or a question, because this is a financial health measurement that is going to help you to be able to improve your financial health, right? Life gets easier with this. And tell me in the comments if this is the first time you're hearing about debt to income ratio. First time you're hearing that you can use a calculation like this to figure out if you have enough money, if you have too much debt, if you can improve your situation. You understand? Tell me, is this new information, is this new details for you, right? Because our job is to educate, empower, and to give you clarity on finances. So this was our personal finance video for you. Business owners, your video is coming next. All right, so we're going to create your video next. Don't worry, we're not going to leave you out of the matrix. But business owners, this calculation, you can use this calculation in your business as well. So sales is the number one category on the balance sheet, revenue. Another word is income. So when you as a business owner are borrowing money, when you are borrowing money from the bank for your business, you can use this calculation as a guide. Say you are thinking about getting to expand your business and you're gonna take a loan from the bank. And you're gonna take a loan from the bank. And you're gonna take a loan from the bank to expand your business. You can use this debt to income ratio. Put the debt, total debt that you plan to borrow from, what the debt payment is going to be. Then you're gonna put the gross income as the bottom, divided by, you're gonna use the total monthly debt that the bank is gonna see that, okay, if you get this loan, this is what you're gonna pay each month for your business loan. And then you're gonna divide it by the total gross monthly income that you have. And as I said before, as a business owner, you're gonna do an average of 12 months income for you to use. So you're gonna have an average total gross income, and then you're gonna times 100%, and you use it now to see where you fall. At this time, can your business afford to take this loan and still have or be rated as being financially healthy? Will you fall into the bad category? Because if you fall into the bad category, that means taking that loan, well, you might not get the loan, because, or you will have to do a lot of justification to the bank to explain why you should get the loan, why you should qualify for the loan, right? So this is not only for individuals, it is for all the income earners. From your earned income, you can use the debt to income ratio to determine if you have enough income, either personally or for your business. If you have too much debt, personally or for your business, and how to improve your situation personally or for your business. So this is, it might be a new thing for you to do a calculation like that, and that's fine. And as per usual, if you have questions, put them in the comments. Put them in the comments so that we know when you have gotten value. Like, hit the notification bell so that we know, you know, when we are on, right? And we're going to be doing shout outs to persons who comment, because we have to reward you for you showing the love, you reaching out, giving us some kind of feedback as to the information that we are giving you. If you're getting value, if you want more of this type of video, what are the areas that are your pain points that you want us to give you some information that will help you to improve, right? Our channel is for the purpose of clarity and education. Yeah, not entertainment. Although my personality might be a little entertaining at times, but yeah, that's just that. All right, guys. So in our, we have clients, one-to-one clients for personal and business coaching. We have one-to-one for personal and business coaching, and we also have online courses like the credit card course, credit card pay off course. So that would be helpful for persons if you want to reduce your debt so that you can improve your debt to income ratio and move from that bad category if you fall into the bad category, or move from the average category to the excellent category. Because some of us, we are overachievers. So we like everything that says excellent. We don't do average. Yeah. So yeah. So all of those lovely things are on the website, moneycoachingservices.com. And you will be able to find what you need there. All right, guys. So as usual, don't forget to subscribe, and we'll see you in another video. If you have time, watch the next video. All right? No, I don't remember which direction the video going to come up, but when it pops up, watch the next video. All right. Bye-bye.